Hello and welcome to RBI Grade B channel. Today we are taking a deep dive into one of the most important yet often misunderstood engines of Indian economy, the monetary policy framework. We will learn how money is controlled, how inflation is tamed, and how the RBI actually pulls the levers that shape the economy. Let's begin. At the center of India's monetary policy lies one crystal clear objective: keeping prices stable. Not in a stiff mechanical sense, but in a way that protects your purchasing power, keeps the economy predictable, and creates a climate where growth can happen steadily. India follows what is called an inflation targeting framework. The target is set at 4% consumer price inflation with an allowed band of plus or minus 2%. That means inflation must stay between 2 and 4%. Even though growth is an important priority, price stability sits at the top of the hierarchy. When inflation remains stable, households plan better, businesses take long-term decisions confidently, and whole system becomes more trustworthy. Unchecked inflation, on the other hand, is like a mischievous intruder that sneaks into wages, contracts, loans, and investments, creating chaos everywhere. So, controlling it is not optional, it is foundational. Now, who actually decides how India's money system should respond at any moment? Enter the Monetary Policy Committee. The six-member team is the decision-making brain of monetary policy. Three members come from RBI itself: the governor, a deputy governor, and another RBI official. Three external experts are appointed by the government. Every member has one vote, and if there is a tie, the governor acts a casting vote. They meet every 2 months and set the path for interest rates and liquidity conditions. Once the committee decides the monetary stance, the next question is, how does the RBI actually implement it? What tools does it use? This is where the system becomes genuinely fascinating. As the center of India's monetary toolkit lies the policy repo rate. This is the rate at which banks borrow short term funds from the RBI using government securities as collateral. If the repo rate rises, borrowing becomes expensive, loans become costlier, and inflation eventually cools. If it falls, borrowing gets cheaper and economic activity accelerates. The repo rate is the main signal to the entire financial system. But the repo rate doesn't act alone. It sits inside what is known as the LAF corridor, the Liquidity Adjustment Facility corridor. Picture the repo rate as an anchor with two guardrails on either side. The marginal standing facility rate forms the upper bound. That is where banks can borrow overnight if they are short of funds. The standing deposit facility rate forms the lower bound, where banks can park surplus money. This corridor gives the financial system the structure it needs to avoid wild swings in overnight interest rates. To maintain stability, the RBI has to constantly manage liquidity, which is the amount of money sloshing around in the banking system. It uses several tools for this. Open market operations allow the RBI to buy or sell government securities. Buying injects liquidity, selling absorbs it. The cash reserve ratio forces banks to keep a portion of their deposits with the RBI. When the CRR, that is the cash reserve ratio, goes up, banks have less to lend. When it goes down, they have more room to support the economy. The SLR, which is the statutory liquidity ratio, requires banks to maintain a certain percentage of deposits in safe liquid assets like government bonds. Then there is market stabilization scheme, used especially during times of excess capital inflow to mop up surplus liquidity. Even with all these tools, there is one particular number the RBI watches every single day. That is the weighted average call rate. This is the overnight rate at which banks lend to each other. The RBI does not want this rate to wander off. It wants it to hover close to the repo rate. If it rises too much, the RBI injects liquidity. If it falls too low, the RBI withdraws liquidity. This daily anchoring keeps the system stable and aligned with the policy stance. Along with these technical measures, words themselves become tools for policy. The RBI uses what is known as forward guidance, which is carefully chosen language that influences market expectations. Sometimes a small shift in tone can move markets more effectively than a rate change. In unusual times, RBI deploys special measures like Operation Twist, targeted long term repo operations, variable rate auctions, and changes in regulatory norms like loan to value ratios or risk weights. These are the economic equivalent of specialized instruments used only when the situation demands. When everything works together, monetary policy becomes a powerful steering mechanism. If inflation rises, the repo rate goes up, liquidity tightens, the cost of funds increases, borrowing slows, and inflation gradually cools. If the economy slows down, the opposite sequence unfolds. Lower rates, easier liquidity, cheaper credit, and eventually improved activity. It is a system that relies on transmission, which is the interest rates affects banks, which affect businesses, which affect households, which finally shape prices. Monetary policy is not about dramatic overnight results. It is about steady calibration, patience, and maintaining credibility. It is slow, deliberate magic, but magic nonetheless. That wraps up today's video on India's monetary policy architecture. The objective of price stability, the committee that sets the stance, the instruments used by the central bank, and the way these tools ripple through the economy. There is a whole universe inside these mechanics. Understanding them gives a sharper grasp of how economies breathe and how the invisible hands of central banks guide that rhythm.